All right, so we have ratios. So far, we have done other tools we use for analyzing and interpreting financial statements. So we've done vertical analysis, we've done horizontal analysis. So we will crown it all with what ratios. In the ratios, we have 5 categories. We have profitability, liquidity, efficiency and activity ratio. We have gearing, and we have investment. It has been categorized into 5. As an investor or whoever who want to, or maybe stakeholder who want to analyze the statement of account of what of a firm, and they want to use ratio for the analysis, these are the key categories that they can also consider in their analysis. Now, let us first look at what profitability ratio. So for profitability ratio, they've given us 4 ratios. It can be more. It can be more than that, but in our professional examination, these are the common areas that they usually set their question around. You understand? So the reason why we've limited it to what these ones. So here the first one is what ROCE. ROCE is what return on what capital employed. The full meaning of this one is return on what capital employed. What does this mean? What this ROCE mean is that investors inject their money into the business. How much are they getting from the investment? How much are they getting? Assuming maybe if they invest 1 cedi, how much are they getting in return for their investment of 1 cedi? The reason why the calculation or the formula is what you see over here. So the formula is what? Is profit before interest and tax, all divided by what? You see, this one in some books, they will do it what? All the equity plus or long-term loan. So or maybe the capital invested plus long-term loan. You understand? But sometimes it brings some certain complications when other informations are added, or other informations were added. You understand? So the simplest way you can get the same outcome is what? When you add all the total assets, then you less what? Their current liabilities. You understand? That will give you what? The same outcome. So here, somebody can also pick what? Their total shares or equity plus their long-term loans. You understand? You add them, that will give you the same outcome. Multiply by 100. Or you can say total assets. Total assets here means that you add their long-term or their non-current assets and their current asset together, then you less their current liabilities. And then we multiply by By 100. Right? So that we will know that how much we've invested, how much will be our returns.
Sir,
Yes.
sir, please, you said in another vein,
In an alternatively, they can say what they can say what all their equity. You understand? Equity plus or equity or their share capital plus their plus long-term liabilities or long-term loans. Personally, I prefer this one because this one doesn't bring any complications. I'll have all their their non-current asset plus short current liability assets, and then I'll let their current liabilities. It's as simple compared to the alternative way. All right. So you have to You have to divide, multiply that by 100%, so that we will see the outcomes. Then we can analyze to understand that okay, if you invest this amount, maybe I'll get maybe 2%, I'll get 3%. So that is what the interested parties use to analyze, right? They can compare year on year. They can compare firms, to know which one brings in returns better. You understand? So if assuming like they've given you year 1, year 2, so the year 1, year 2 they've given it to you, then you are performing ROCE. So you analyze by comparative to see that maybe year 1 they were able to get more ROCE, year 2 they were able to get less ROCE. Then you can justify the reason why this one is more profitable than this one. Okay. So that is it about this one. Now the second one is what? Net profit margin, right? Net profit margin. Net profit margin is how much, you understand? So how much are they How much is their profit against their what? Their total sales. You understand? So here, this one will also what? Give the investors or interested party so far their profits against their what? Their net profit. So this one, they are against their what? Their revenue or their sales. So with this one, it will help them also to know their returns, actually, the profit compared to how much that they've made. And you can use that one to do your analysis.
Please, you give a simple definition. That
Which
how
one?
much is there something against something?
Which one?
Net profit margin.
Yeah, I'm saying that net profit margin, you want to know the returns or the profit that you get from the what? From the total sale that you've made. The idea about this one is that they want to know, maybe comparing year on year or maybe firm by firm, to see how they've been able to what? Manage their resources. You understand? How they're able to what? Manage their resources, make sales, then they will use that one to compute with the net profit margin to see the profit or the outcome of what? Of their operating, or maybe at the end of the accounting year, the rate of what? Percentage comparing to their what? Total revenue. You see, this one will give you the fair idea whether after they had their revenue or their sales, how are they able to manage their what? Manage their direct and indirect what? Cost. You understand? Because this one will give you the fair idea. Because when the net profit margin is up compared to your previous year's accounting year, it tells you that probably the company is able to manage their what? Their expenses, administrative expenses, their direct costs, and so on and so forth better than the previous years. That is the idea with regards to what? The net profit margin. You understand? Because at the end of the day, the value of the company increases when their net profit increases. So how are they managing their what? They managing their what? Their direct and indirect what? Cost or expenses in their operations. So that will give you what? The margin. That gives you what? The margin, the total margin at the end of the accounting year, to see whether indeed you've been able to manage their what? Their cost, administrative costs, direct costs, indirect costs, and so on and so forth. That's the idea about what? The net profit margin. So that one to say the formula is what? Net profit before interest and tax, all divided by what? Total sales. You understand? Because at the end of the day, when you compare year one and year two, right? When your profit margin is up compared to the previous years, indeed, you realize that then maybe there's something that you've done right, or it can come from 2-3 points. It can come from what? Your ability to control what? Cost, or your ability to what? Increase what? Revenue or sales at the end of the day. That will have what? Bearing on what? On your profit margin. Now let's also go to gross profit margin. Gross profit margin is also what? Your cost, your cost of sales from your what? From your revenue or your sales. That gives you what? Your gross profit margin. So with this one too, we want to also look at the point where the company is able to manage their what? Their direct cost. So direct costs, they are what? They are costs that went directly into acquisition or purchase of raw material for production. You understand? So here, the better your gross profits compared to the other years, the better the management of what? Of the purchases department of the company. You understand? Because if your department of what? Your purchasing department is very good in negotiation, they can negotiate better price for the company. That could have what? Impact in their gross profit margin. That one also talks about the cost that are direct. But when you come to net profit margin, they are what? They are the final outcome of their operation. So here, net profit margin combines both the direct and indirect cost of what? Of administration to determine maybe the outcome at the end of the accounting year. Now let's look at return on equity. The gross profit margin, so the gross profit over the total sales, that gives you what? Multiplied by 100, that gives you what? Your gross profit margin. All right. Now let's come to what? Return on equity. So return on equity is what? how much are they? When we say equity, I believe you and I all understand what equity is all about. You understand? So equity is the shareholders what funds that they introduce in the company. So far we've invested. The shareholders have invested. How much is their return? We want to know. At the end of the day, it will also give us a better idea that possibly our investment are being properly managed, right? All right. So they will look at it. So that one is profit after tax minus what preference dividend or divided by equity times what times 100. So here clearly, as I earlier indicated, the equity is what is the money the ordinary shareholders have invested, right? So if you want to know how much the total in percentage was, how much will come to the equity shareholders, you have to remove what? You have to remove the preference share dividend from what? From the profit. You understand? So just like maybe you have net profit of maybe 20,000. Now you want to check return on equity. How much return that can, because if you have net profit of 20,000, this 20,000 is what is a return. So this profit net profit of 20,000, when you take it to statement of financial position, it becomes what? Retained earnings, right? It becomes retained earnings. Now, if we don't pay, that means if you don't pay dividend, so the net profit 20,000 will go to a statement of financial position as what? Retained earnings. Now, these 20,000, if you are preference shareholders, you have to pay them off, right? You have to pay them off so that we can know how much is left for only the ordinary shareholders, right? So for that reason, if you are preference shareholders, you less the preference shareholders money from the profit. You understand? So the left will be left with what? For the equity shareholders or ordinary shareholders. Then you compute and know the actual returns, right? So this is more like you want to check the dividend that will accrue to the ordinary shareholders, the rate. Because I don't know, when you less the preference shareholder dividend from, the rest belongs to the ordinary shareholders. All right, so that is it about the profitability. Any question? Now let's move to liquidity. When we look at liquidity, the category that also assess, how liquid or solvent the company is, right? You remember in 2018, right, when a lot of banks were insolvent. You remember what happened to the banks? You remember?
Yes, sir. There are
Uh-huh.
7 or 8 banks.
Yeah, so they use this liquidity to do the calculation to know whether their companies are solvent. You understand? Because at the end of the day, you should have enough working capital to take care of day-to-day activity operations of the company. So if at the end of the accounting year, your liabilities, your day-to-day liabilities, or maybe your current liabilities is more than your non-current asset, it means there's a problem. You may not be able to meet all your obligations with these resources. So this is what we use to also to determine that. Now, let us look at the first one is what? Current asset ratio. So the current asset ratio is what? Current asset over current liabilities into what? Is to 1. So here we want to know the number of times your current asset can pay off its current liabilities. You understand? So if it is 1:1, it means that our current asset can settle our current liability 1 time. You understand? It means there will not be any other reserve available. Yeah, ideally it is said that your current asset ratio should be at least 2:1. You understand? It shouldn't be so much. It shouldn't also be so big. You understand? When it becomes big as well, that one, so there's a problem. It means you are holding a lot of it. Either you are holding a lot of money or your inventory is so big. You understand? And you don't also be you shouldn't be holding such asset also that much. You understand? So you should be in between. You understand? So here, in regards to the current asset ratio, as earlier indicated, we use to assess whether the company is liquid or the company is solvent to meet its current obligations. All right, so that is it about that. Now let's look at asset test or quick ratio. The asset test or quick ratio is also one to determine how quickly the company can settle its current liabilities, right? Because some of the debt cannot wait to settle it. Example like bank. So bank, the asset test is what is usually it should be what we can use to test it, because each and every day people will come to the bank and do drawings. So if you don't have readily available money, there will be a problem. You understand? People will start flagging it out that they can't access their money, and Bank of Ghana will also wade in, and if care is not taken, they can also what pull out the bank because you cannot meet your parent obligation. So here, as I have already told you before, your current assets, which consists of your inventory, your receivables, your bank, your maybe your advances that you've made payment, and so on and so forth. If you have something like inventory or your receivable, you have receivables, or maybe your inventory, these assets, you shouldn't go more than 6 months to convert it into what? Into liquid asset. You understand? You shouldn't go more than 6 months to convert it to what? To cash. So if you want to test whether today or tomorrow the company can still have money to meet its obligation faster or fast, demand obligations, you use asset test. It means you have to remove inventories, because some of the inventories, it can take some many months for you to convert it to cash. You understand? So if they want to test whether the company can meet its a day or two obligation, we use asset or test or quick ratio. So with this one, we have to remove inventory from it. Then the rest we can calculate it, and then so here you add all your current asset, then you less only inventory, right? Then you divide by our current liabilities. So that gives you asset test or quick ratio. Okay, so I believe you've understood this portion as well.
Yes, sir.
Good. Now let's go to the efficiency ratio. Now, efficiency ratio, we have first one, what we call inventory turnover period. Here, we want to multiply by 365. So when you multiply by 365, it means that you want to know in the number of days. What does it actually mean? So here it can also be called what we call day inventory outstanding. So with this one, in some book you see they say inventory average, right? In some book they say inventory average. What they mean is that maybe they will give you the beginning inventory, and at the end of the accounting year then you add the two, then you will divide it by by 2. You understand? Maybe if you have opening inventory 20,000, then they'll give you closing inventory maybe 15,000. You add the two, then you divide by by 2. So that gives you the inventory term, all divided by by the cost of sale. In some formula, if you don't see cost of sale in the P&L, use purchases. If you don't see cost of sale in the question, if you don't see cost of sale in the question, please use use purchases as a denominator, right? Okay, so yeah, we want to know the number of times for inventory turnover period. You understand? So, for example, if maybe the company is able to produce maybe 50,000 units of their product, how many days can they take to sell off these 50,000 units? So here, the earlier the better. Is that not the case? Example, maybe you are please, the earlier the better. Here, what they mean is that they are comparing year 1 and year 2. Maybe year 1, they have inventory turnover divided by cost of sales. They give it to you calculated. So year 1, if it is in the days, they will give it to you 365, right? So here it took them 24 days for year 1. Year 2, it took them maybe 15 days. So which one will you say is preferable? You will take the year 2, because which is less days you understand? That one is less days to sell off the inventory. The earlier the better. And when they want you to if they did not give you, they didn't give you already calculated for comparison, and they want you to what? They want you yourself to determine the formula for efficiency ratios, and you pick inventory turnover. You can choose to make it days. You can choose to make it what? Month. You can choose to make it what? Weeks. You understand? So if it is the number of days, the total number of days in a year is what? 365. If it is in the month, you multiply by 12. That gives you the number of months, right? If you want to make it weekly, how many weeks are there in what? In 1 year? How many weeks are there in 1 year?
52 weeks.
52 weeks. So if it is 52 weeks, then you multiply by 52. So that gives you the number of weeks. So you take note of that. So let us look at so here, that's, you see, you call it efficiency. So how efficient is the company that is able to sell its inventory faster? So if you're able to sell it faster, that means you are very efficient. Okay. We have trade receivables. Trade receivables is also part of the efficiency ratio. They want to know the number of days the company can use to collect its debt. So how many days can the company use to collect its debt, right? So that is trade receivables. The earlier, the better for the company. If you're able to collect, or you can put in so when you are coming to do the analysis, that's where you can you can state what ought to be. So that is it about trade receivable. Then we have asset turnover under the efficiency. So the asset turnover, the formula 2 is what? Sales over net asset. So how do you understand what asset turnover?
How assets has been used in order to receive revenue.
Okay, all right. So asset turnover, as you rightly
The
said.
usage of assets in order to receive revenue.
Okay, so you can see the formula with what? Sales up there. So asset turnover. How did you use the asset to make money or to generate revenue? That is what you can find. So here it was sales over over the net asset. When we say net asset, how do you understand net asset? The net asset means that you have your total current and non-current asset, then you less your current liability. That gives you your net asset. Have you understood now? So your net asset, your long-term asset, and your short-term asset plus your short-term asset, then you less your current liabilities. That gives you your net assets. Now sales over your net assets. We want to know the returns. You understand? So here, the formula at the end of the day, that's asset turnover. So at the end of the day, if you divide it and you get maybe 3 cedis, right? It means that when we invest 1 cedis, we are going to get 3. How much are we getting? How much is the return when we invest 1 cedi in the company, right? All right. So that is what this means. Now let us come to the fourth one. Fourth one is what? Inventory turnover. How do you understand inventory turnover to be? Right. So first one, check. Look at the first one. You look at the first one. We have inventory turnover period, and this one is what? Inventory turnover. How do you understand it? Please, have you understood?
Yes, the other one is on time. This is inventory. How inventory has been used to generate a return.
No, watch it very well. Inventory turnover. Watch it. You see, first one is what? The first one is what? Inventory turnover period, right? So that means you want to know the number of days that you can turn around the inventory, right? Maybe you can take, maybe if you have inventory of 50,000, how many days can you use to sell off the inventory of 50,000? That's what the inventory turnover period, right? Now, when you come to the reason why we bring the number of days there. Now, when you come to inventory turnover, how do you understand it? You understand? So this one will simply mean that we want to know the number of times. You understand? So assuming like you have inventory, right, for the number of years, for maybe 1 accounting year, how many times can you replace your inventory? That means if maybe you can produce the quantity you can produce and sell, you can take 1 month to produce and sell. So you produce within one accounting, within 1 month, you produce. How many days will it take you to sell off what this very good that what you produce in that month? That comes with the fact that when you look at the first one is what the number of days you can use to sell off. But here, this one talks about the number of times you can produce and sell within that accounting year. So if every month you can produce and sell all within the next month, then let us look at the number of times you can produce and sell within that one accounting year. Example, if one maybe January when you produce in the month of January, within the month of what February, you sold all the inventory. March, or maybe in the month of what February, while this one is in the market selling, February you started production. So February you produce. Then in the month of March you sell all the product. In the month, whilst you are selling in the month of March, you are also in the production in March. Then you produce. So you see that it will take you like your turnover will be what? Will be 6 months. The number of times is what will be 6. Please, have you understood the inventory
Yes, sir.
turnover? Have you
Yes,
understood?
sir.
Aha. So that is what this tries to
Yes, sir.
mean here. So here you want to know the number of times you can produce and sell. Is it 5 times? Is it 3 times? Is it 4 times? So you should know the difference between the inventory turnover and inventory turnover period. The larger the number, the better off. You understand? Because if you can produce maybe 6 times, or you can produce and sell 6 times within one accounting year, it means your product is demanding. But if assuming like you produce and sell maybe thrice a year, it means you struggle to sell off your product. Is that not the case? Still under efficiency ratio, we have what? Trade payables. So the trade payables, sorry, the inventory turnover, the formula is what? Cost of sales over what? Over inventory. Now, cost of sale, I said that if they did not provide you with what? Cost of sale, use what? Purchases. You understand? In place of what? Cost of sales. Okay. Now, the last one is what? Trade payables. So the trade payables is also, we want to look at the number of days it takes the company to pay off its liabilities. You have trade payable divided by what? Divided by the sales, right? Multiply by the what? Multiply by 365. Now here, what this one means is that how many days does it take the firm to pay off its what? Its liability or its credit. You see, the earlier you pay, the better for the company's image. And the earlier you pay, remember, you are losing money. You see the whole thing. Also, the late you pay, the effect on the company's image.
The trust.
Right? However,
the trust
the better
of
off
your
you use money to turn around your business. So here, you have to be within a certain acceptable limit. You understand? With your suppliers or your trade creditors. You understand? You shouldn't be someone who can easily just pay off, or you shouldn't be somebody who is also being lackadaisical to pay off. So all of them has what consequence. So you should fall within, a certain limit. Are we okay? Okay. So that is it. So you take note of what? The efficiency ratio.
Yes, sir.
So you should what? You should be very mindful of what? Efficiency ratio. Because when you look at the trend, usually they will give you ROCE, they will give you what? Net profit margin, and they will give you what? Current ratio, right? You should take note of that. And the efficiency ratio, they also bring trade payables, in most cases, receivables. So we take note of that. Okay, so we are done with our trade payables. So let us come to gearing. Gearing is about, what is gearing? When we say gearing, how do you understand gearing?
Yes, we are talking about how an entity uses either its debt or equity.
Okay, so simply means
in order to be able to run.
So it simply means that the extent of which the company would finance its business with debt relative to its equity. right? So here, how much is the what? The structure or the equity structure of the company. So when you look at the equity structure of the company, you see the equity shareholders amount, and you see what long-term debt or loans also amount under the what, under the finance. So here you compare the what, you look at, I mean, how much so far the shareholders are contributed, and then how much loan is also financing their what, of their business operation. That is gearing. If assuming the total equity of the company is 500 million, right? 500 million. Now, how much did the business owners contribute? Maybe 200 million. The 300 million is what? Is from debt or is from what? Loan or long term. So here you realize that the company is being run by loan than the what? Than the self-financing or the shareholders fund. That's what we call gearing. So here,
Sir, you give an example. You give an example by saying that if equity is 500,000,
if equity is if the total if the total fund for the company is 500 million, and then the shareholders fund is 200 million, and the 300 million is funded by what, by long-term loan. So here you realize that the company is what, is being run on debt than the what, than the self-financing. So you realize that the company, the equity structure of the company, you have more loans running it than the what, than the ordinary shareholders what, funds, right? So when that happens, we say that the company is more gearing, and it is very dangerous to the company, right? Because if the company, the how much the company is being funded, more is coming from loans or external institution than the ordinary shareholders. So it is not good for the company, because the company will be what, will be paying more interest on their what, on their business activities than what, retaining what, earnings to increase the value of the company. You understand? So if care is not taken and the company is in distress, a bit distress, I mean, they will find it very difficult to finance their loan. And when they are unable to fund their loan interest, the company itself will find itself in what, in a bad. So the reason why we advise that at least, or maybe at most, it should be 50-50, 50% equity and 50% what, loan or external what, sources. Because if your company is being funded from what, from external bodies more than the shareholders, it is not good, right? Because you end up paying more interest on your what, on your business operations. And you see, the more you pay interest, right, the more the company is not what, will not be progressing. You understand? So the reason why in most cases we advise that when you want to start a business, don't start your business with loans, right? At least find some sources that is your self-financing, so that it will what, it will give you some room to operate over some time, than to once you started, then all the money that you get, you use to pay loans. You understand? It will stunt the business. The business will not be progressive, right? So that is gearing. Now we have three methods, right? Okay, but in some books they limit it to two. Now here we have what, first one, debt to equity ratio. So you will pick the what, the debt to equity. It means long-term loans. Please, have you seen it?
Yes, sir.
Long-term loans, right? Debt to equity. So long-term loans divided by what? By the equity. Are you with me? Then you multiply by what? By 100%. So that will give us the total component of how much the company is what, being funded by external institution and what, shareholders. Yeah, all you have to, so debt to equity. So all you have to look out for is your what? You look out for the total debt of the company. When we say total debt, do you understand total debt? Okay, so that's
That is the non-current,
come again.
non-current liabilities.
Okay, so that's what your long-term liabilities. So that is your what? Your liability divided by what? Your equity that you have. So you have long-term debt, preference shares. So plus preference shares, long-term debt into bracket, preference shares, all divided by equity plus what? Plus your debt. Okay, so here all you have to look out for is your what? Is the total long-term debt of what? Of the company, all divided by what? By the equity plus what? Plus the long-term debt. So here you are looking at for this one, you are looking at for the total equity of what? Of the company, both shareholders funds and what? And the long-term loan combined, all divided by what? By the long-term debt of what? Of the company. You understand? So that will give us what? The actual component of amount or the rate, how much is what? Is being funded by what? By external institution. You understand? To the what? To the total equity of what? Of the company. So that is what where you should. So we should look out for it. So you have what? Your long-term debt, all divided by what? All divided by long-term loan plus what? Plus equity. So that will give us what? The tiering that we are looking for. But when we look at what? Debt to equity. So debt to equity in most cases will be what? Will be short-term loans and current loans, all divided by what? By the equity. You understand? So this debt to equity, you have your what? Your short-term and long-term loan combined divided by what? Equity. So this one is shareholders funding. This equity is shareholders funding, and then the debt is what? Is a long-term and what? Short-term debt, all divided by the equity. So that will give us so far how much the company shareholders have funded the company, then to how much is what is being funded from external institutions. Okay, so when we come to this gearing, so the gearing here, we are talking about only the long-term loans, all divided by what? By the total equity of what? Of the company, being your what? Your shareholders funds plus what? Plus the long-term loan. So that gives you what? Whatever you are looking for. So that will give us a fair idea whether the company is geared or not. Because here when you calculate and the percentage is maybe 60%, it means you can conclude that the company is gearing. You understand? The company is gearing because they are being funded more from what? From the loans than what? By self-financing. So let us look at interest cover. Interest cover is also under gearing. Here we want to know, right? Here we want to know how much the company can pay it what? Can pay interest on its debt, the number of times, right? So in most cases, the gearing aspect, they can ask you the second and third one, right? How the company is being funded and what also the interest cover. So here they want to know after you've realized your profit, so that's profit before interest and tax. Then we divide it by what? By the interest that we have. Then we can know the interest cover. What this means is that the profits before tax that we have, when you divide it by the interest that the company will pay on its debt portfolio, what is the number of times? So if the company interest before tax, probably before interest and tax is maybe 50,000, and then you multiply by the interest that the company will pay on its debentures, long-term loans, and so on and so forth. Maybe when you divide it, and maybe we had maybe 3. It means looking at the profit before interest and tax of the company, they can pay 3 times of their interest on their loan. It means the company is liquid to cover much of its the current liabilities. Do you understand? Over the period. So that is about the gearing. Any question up to this point? The final one is investment ratio. So the investment ratio, we want to the investors or potential investors want to know number of these. You understand? Before they can invest. So they want to find out earning per share. This company, they will pick their financial statements and go to statement of profit and loss account and then start doing some certain calculation. They want to know profit after tax profit after tax, earning per share. They want to know shareholders' earnings per share. So here you need to have what your net profit you have sitting there. Then you less ordinary share, what do you call it, the preference shareholders dividend from it. The rest left is for what? Is for shareholders. Is for shareholders. If so, let's look at it unit per share. So if maybe unit per share of the company is maybe 1 cedi, what is the profit on this 1 cedi? You understand? The ordinary shareholders. So ordinary shareholder have maybe 50,000 shares. If I have 50,000 share, 1 share is maybe 1 cedi. Okay, this 1 cedi, what is the profit on each 1 cedi that I have invested in the company? That's the earning per share. So you need to have the total profit of the company. Once you know the total profit of the company, preference shareholders, you have to give them their dividend. You understand? So you remove the dividend from what? From your net profit. Because whether the company makes profit or not, you have to what? You have to, give them their dividend. So if the company did not make profit this year, you have to carry it to the future, so that when the company makes profit, then you pay up that what? Dividend to them. So for them, when the company makes profit, you need to what? Less their preference shares down. The rest belongs to your ordinary shareholder. So if the rest belongs to the ordinary shareholder, we can calculate the what? Earning per share on that left net profit. How do we calculate it? So you need to pick what? Profit after tax. Then you less our preference share. Then we divide by number of equity shares the company has. So that gives you the investor that, okay, this company, if you invest 1 cedi, you can get maybe 50 pesos. You understand? So that is earning per share. That is what? Earning per share.
Yes, sir.
Okay. So that means every share they are going to earn maybe 1 cedi. Every share we are going to earn maybe. So when we divide, whatever you get will give you the fair idea, the returns. Okay. Now let us come to earnings yield. So we know the formula for earnings yield. So the earnings yield is what? Earning what? Earning per share over what? Market price per share. That is what? Earnings yield. Then you multiply by what? Multiply by 100%. So what do we get here? So the earnings yield. So what is it? So you have what? Earning per share divided by what? Market price per share. So we have to know the market price per share of what? Of the company first. Then the earnings yield. The earnings per share. You already calculated the what? Earning per share. It means that the idea is that how much is your what? Your unit per share is yielded in percentage wise. You see, when you look at the first one, it will give you raw figure. Please, are you with me?
Yes, sir.
It will give you what? It will give you the what? The raw figure. But if you want to know the yield, how much the thing is yielding in percentage wise, how do you calculate it? Are you with me? So if you know the market price per share of the company, so if the market price per share of the company is maybe 50 cedis, and the earnings per share is maybe 5 cedis, so it will give you maybe 10%. So 5 over 50 will give you what? 10%. It means your investment has yielded what? 10%. So that is what we call the earnings yield. So let us also look at what? Dividend per share. So the dividend per share, assuming the company made profit of what? 50,000. Listen very carefully here. The company made profit of what? 50,000. Now, this 50,000, we have to less the preference shareholders dividend from it. So we less it, maybe 10,000 will go to the preference shareholders. Now we are left for 4,000. This 40,000 belongs to the ordinary shareholders. If this 40,000 belongs to the ordinary shareholders, so we want to know earning per share. We can calculate earning per share dividing by what? Dividing the number of shares in equity, so that we know the earning per share. If you want to know the dividend per share, so here, there's 40,000 left. If the company decides not to pay dividend on it, then you can calculate earning per share on it and say that, okay, there's the earning per share of your investment that you already have in the company. So the value, because they didn't pay dividend, they will take all the 40,000 and to what? To the statement of financial position under what? Retained earnings. Now, how about if the company decided that year they would declare dividend? So 40,000, they decide that they will declare dividend of maybe 40% of the money. So out of 40,000 remain, they said they will pay 40% of that money as dividend to the shareholders. So when they calculate 40%, whatever left, as in when they calculated the 40%, the 40,000, maybe they had 25,000, right? So this 25,000 divided by the number of shares the company is holding. That gives you what? Dividend per share. Are you with me? It will give us what? Dividend per share. So that means when they divided and then they had maybe 50 pesos, it means every share that you hold, you have what? 50 pesos worth as dividend. So that's what we call dividend per share. Dividend per share. Now, let us also look at what? Dividend yield. So here, the dividend yield, just like we did earnings yield up there. So here, dividend yield here means that in percentage wise, how much is your what? Is your dividend yielding for you? So when you look at the first one is a overall of what? Of the net asset. Overall of what? Of the net profit. But when you look at the dividend per share, it means they've now declared dividend on the money. So how much is your dividend that is going to be paid out yielding to the ordinary shareholder? Maybe if it is 50 pesos that they are giving out, maybe 50 pesos over the market price per share will give us what? In percentage wise, how much is your investment or unit per share that you bought is giving you? Maybe 8% on what? On your investment. That is what this means. Do you want me to demonstrate on board for you, or it's okay if you understood?
It's okay, sir. Let's go.
All right. We've now understood what dividend here. So let us look at PE ratio. The PE ratio is what? Price earning ratio, right? That one too, they want to find they want to find the PE ratio of the company, right? So what is the PE ratio of the company, right? Okay, so if they've asked you what the PE ratio of the company, you should be able to know the formula for PE ratio, which is what? The market price per share over what? Over earning per share. So that is what? Price earning ratio. Use this one to measure how much an investor, you understand, how much an investor is willing to maybe pay maybe every 1 cedi of what? Of the company's earnings. So if you are an investor and you want to invest in a company, you can use PE ratio to determine the price earning ratio of what. So you use that to measure how much company maybe investor is willing to pay for maybe every 1 cedi of a company's earnings. All right, so if you are an investor, that's how you calculate, you look at it. So example, if the company investor want to see, okay, how much can I pay for each of every unit per share of what? Of the company. So here, if maybe the market price per share is maybe 60 and the earning per share 3 cedis. Now, when you divide it, it will give you 20 pesos, right? Okay. Or 20 cedis. Okay. So the investor who want to what? Invest in the company will what? They will pay maybe 20 cedis for every 1 cedi the company, or every 1 cedi of what? Of earnings of what? Of the company. You can also say that the company or the investor, they can use that one to also, check whether the value per share of the company is cheap or what? Expensive. You can use that one to what? To, check that.
Let me move you back. You said it is used to measure how much an investor is or will be willing to
It's
pay
willing
for
to pay.
everyone.
It's willing to pay. It's willing to pay. So here, what I mean is that you use that one to measure how much an investor is what? Is willing to pay for every maybe 1 cedi of what? Of company's earnings. Do you understand?
Thank you. Thank you.
And I cited example, like maybe if you have market price of the share is 60
60,
and
60
earning is 3 cedis. When you divide, we give you 20. Yeah, so investors are willing to pay for maybe 20 cedis for every one of what? Of the earnings of what? Of the company. So which one is left? We have what? Dividend cover. Now,
Cover.
dividend cover is also, we use that one to also measure how much the ordinary persons or ordinary shareholders can what? Can also, know how liquid the company is in terms of its dividend payment. So yeah, the dividend cover here means that, okay, you have profit after tax. Then you less all the what? The preferred dividend from it. So whatever is left is for what? Is for the what? Ordinary shareholders. Then you divide by the ordinary dividend. You understand? So if the company declared dividend, maybe they declare 40% dividend on their what? On their net profit. So how much is it? Maybe when the dividend payout is maybe 25,000. So let's look at the total profit before interest and total profit after tax less dividend. How much is it? Then you divide by what? By the payout amount, maybe 25,000. Whatever you get will give you the dividend cover. It means the number of times this company's money can pay a dividend over time. Right? So when you divide and it is 2 times, or it is 2, it gives you 2. It means this dividend can work. If it is constant dividend payment, then this dividend can pay twice. So clearly it will show that the company is what is liquid to pay that number of times. Then let's come to dividend payout. So dividend payout, what is the dividend payout? So dividend per share over earning per share times 100. So this one give you what? The percentage of dividend they are paying out. So here, if the company, the earnings per share, have you seen this earning per share? If you want to know the total net profit available to ordinary shareholders, you will pick this unit earning per share, you multiply by the number of shares. It will give you your total what? Profit. You understand? It will give you the total profit attributable to ordinary shareholders alone. That will give you a total value amount. But here, earning per share here means that they've already divided by the number of shares by what? By the profit. That's why you had what? Earning per share. Now, dividend per share, it means out of this earning per share, this earning per share is what? 100%. And if they decide to pay, maybe, assuming you have earning per share of, let me demonstrate that here. Dividend, what is the formula? So they want you to calculate for dividend payout. And they've given you maybe the number of shares. If the number of shares of the company is maybe 800,000, and they say that dividend per share is maybe 2, and they give you earning per share is maybe 5. So how did they arrive at dividend? How did they arrive at what? Earning per share. That's what I want you to know. So here, what they mean here is that if you want to know the dividend payout, it's what? Dividend per share divided by what? Earning per share times 100. So you will have what? 2 over 5 times 100. What do we get?
40.
So here it means they what? 40%. So it means their earnings that they've had, they are paying 40% of the money. And I'm saying that the dividend per share, earning per share here means this. It is what? It's 5 multiplied by what? By 800,000. What do you have here?
4 million.
So you have what? 4 million. This is what? Profit after dividend. This money you see over here is what? Profit minus what? Minus preference shares what? Dividend. And they divided this one to give you 5. They divided this one by what? By 800,000. That gave you what? This very 5. So that's the demonstration that I want you to know. So here, once you know your what? Your 4 million here. If you want to know, so this is your 4 million. So this 4 million, if you want to know your what? Your actual payout of what? Actual payout in value of what? Of the dividend is what? Is 4 million multiplied by 40%. And so whatever you get is how much they are paying as dividend. So when you multiply, what do you have?
1.6.
So 1,600,000.
Yes, sir.
So this is dividend payout. So this is the total dividend. So this is a dividend. And so if you want to know the unit per dividend per share, you multiply by what? You divide by 800,000.
800,000.
You understand? So that gives you a dividend per share. So that is the meaning of all that you are saying. Okay, so that is it about that. Okay, so that is all that I want to demonstrate for you to